Hi, everyone. It's good to be back with you. Welcome to the panel. We're also going to stick to time on this conversation. Given the subject matter and the question of what's driving growth in alternative asset classes, Greg, I want to start with you. We've seen a massive shift in investment to alternatives in the past 10 years. Do you see this trend continuing in the near and perhaps couple of years ahead?
I do. Well, first of all, thanks, Bianna. It's great to be here and great to be at FII Miami. And really impressive to see what His Excellency and Richard have pulled off in pulling this together, and great to be up here with such esteemed investors. The trend in alternatives is here to stay, and I think it's really driven by performance. If you look over any period of time, the performance of alternative assets has outperformed anything else. And the traditional 60-40 allocation of equity and fixed income and cash, I think, is gone by the wayside. But private equity has outperformed the public markets. Private credit has outperformed fixed income. You look at real estate, infrastructure, in particular venture, you've just seen incredible performance. And so I think any sophisticated investor needs exposure to it to get the performance they're going to want. I look at from our firm's perspective, we have a little bit of a different investor base, which are founders like Michael Dale, who spoke earlier, or family businesses, and they've got a real issue around concentration. Their wealth is concentrated in their family business, or it's concentrated in their single stock position. And one of the great things about alternatives for anyone, and in particular for our client base, is diversification. And it's diversification and driving risk-adjusted returns. And so if you think about long-dated private equity, private credit driving yield, real estate, again, long duration real estate driving yield, it's really a perfect balance to a portfolio, and it's got a long duration element to it.
Rishi, which asset classes are you focused on now the most and most bullish about?
Yeah, so if you look at the landscape of private markets, broadly speaking, you can divide it into 3 or 4 asset classes. Private equity, of course, in all its shapes and forms, from venture to growth to buyout and large cap buyouts. Private credit, both the traded side as well as direct lending. Real assets, which for me means both real estate investing as well as infrastructure, and then liquid alts. Now, liquid alts was hedge funds and the likes of that. Liquid alts is basically a package, right? It's a wrapper around what is still predominantly public markets investing. So focusing on the purely private side of the equation, we see those 3 primary asset classes, private equity, real assets, and private credit, all having a bit of a tailwind to them, right? And Greg referred to the fact that performance has proven itself. There is an alpha to be captured. But more importantly, the other thing that's happened over the course of the last decade is that perceived illiquidity within private markets investing has dissipated quite a lot. It's dissipated because there are new innovative structures in terms of offering access to private markets investing for retail investors, high net worth investors, et cetera. But most importantly, the maturation of the secondary markets has come into play. And what people thought they were compromising on or giving up on through investing in private assets in terms of liquidity is no longer as acute a concern as it used to be. So performance, liquidity, and the fact that you're getting that diversification at a lower risk profile, so your efficient frontier is that much higher, has all driven the increased allocation towards private markets, particularly private credit, real assets, and private equity.
And now I know your focus a lot is on real estate. A lot of different views on the future of real estate and where things stand right now and its stability and what we can expect to see. Your take?
Conversations this morning about the fact that we constantly hear about the real estate and commercial real estate being the source of potential problems, and particularly in the US and Europe. But then underneath the surface, the media or the coverage is not focusing on a lot of sectors that are actually performing well. So we were talking about student housing, medical office, logistics, data centers, as Mr. Schwartz was talking about earlier. All of them are performing really well, and the U.S. as an economy is continuing to deliver long-term trends that are supportive of all these sectors. So in a way, and probably I'm biased because this is our business, we continue to see opportunity. We continue to see opportunities for investors to deploy excess capital, and that's what our part of the world does. It invests excess capital in economies and in opportunities that deliver the diversification and the returns that they want.
Scott, taking a step back and looking at where we were and how we got here, coming off a really turbulent period, we saw a fast rise in interest rates, uncertainty, and crisis in the banking sector, including some high-profile collapses. What is your take on how much these disruptions have impacted the growth in alternative asset classes, and is it sustainable?
Sure. Well, last year was a tough year, I think, for alternatives fundraising. It was down for the first time in a long time. And part of that's driven by a lot of the average LP in alternatives finds himself overweight private equity and real estate relative to a yield opportunity that's now been created by the rise in rates. And you had a shock to the system, which is actually, I think, going to drive more alternative opportunities, but it's going to drive them into credit. When we say private credit, we don't just mean corporate lending. It's ABS lending to autos, aviation, shipping, maybe GPU processing. So there are all these either investment grade or leverage finance, private credit opportunities that the whole universe is pretty underinvested to. And because of Basel III Endgame and what's happened with the banks, the regional banks having to sell assets last year and the big banks being impacted by Basel III Endgame, you're seeing whether it's SRT transactions where they're moving assets off their books, not participating in the same way they have in the structured finance plumbing in the US and globally, a real opportunity that is not billions of dollars, but trillions of dollars in size for alternative finance. And I think it's going to drive dollars out of, on a relative basis, private equity into yield-based products that don't have the same volatility or equity risk. You're at the top of the capital structure, you've got similar returns. So that's where I see the growth. And the Basel III Endgame thing is going to drive a lot of it. We're seeing a new bank every week that's offering an SRT transaction or strategic risk transfer, synthetic transfers. And I think that's something that will continue. One other point I would make before I end is that real estate is something that people seem afraid of right now. That might be the best lending opportunity over the next 10 years.
Yep.
And I would really be focused there in terms of how can you lend
so?
at the top. Well, there's going to be bankruptcies, and then there's going to be new money needed. And if you can lend at the top of the capital structure on a new capital structure, not an office, but on assets you like some of my fellow panelists were talking about, that's a really interesting opportunity.
Rishi, did you want
I was just going to say, so I completely concur with Scott in terms of the attractiveness of the private credit space, broadly speaking, particularly over the course of the last 18 months and for the next, let's say, 24 months as rates continue to remain at expectedly elevated levels. But the one thing I would say, Scott, is I don't think it's going to be a shift from private equity to private credit. I think what is more than likely to happen is that the traditional 60-40 portfolio is going to become a 30-20-50 portfolio, where the 50 is an allocation to private markets, about a third in real assets, a third in private equity, and a third in private credit. At least with our investors, we are not seeing them allocate away, we are seeing them add, right? We are seeing them add to real assets, particularly infrastructure, because they see it as a natural hedge for inflation with a long-term duration attached to it, and to private credit because they see it as a natural hedge to duration risk, right? Interest rate duration risk.
I think you're seeing a lot of investors globally in this interest rate environment think about their liability structure, like we all do every day, and the opportunity to term that out is pretty incredible.
Jared, let me bring you in and factor in the geopolitical tensions, two hot wars going on in the world right now, and how you view, given your background and your travels, that impacting potential areas of growth, and how you balance what you're telling investors in terms of the concerns that these wars only seem to be escalating and prolonged.
Yeah, so what I find is that a lot of people are always trying to get a determination of how long will this go, or what's going to happen, or what will be the spillover effects. And what I always try to tell people is nobody knows, right? Because at the end of the day, it will be based on decisions by humans. And with every situation, I could give you the positive ways that it could end, and I can give you the negative ways that it will get worse. So you really have to make an assessment based on the inertia, and then what are the interventions you see possible in order to achieve the upside case. The way that we've handled this is obviously you always want to go to the best markets. I always learned through my different investing careers that the more you're in kind of quality locations, quality products, that you'll just be able to go through these cycles over time. If you have duration and the right capital structure, you should be able to kind of weather whatever dislocations occur. But I would say that we've been mostly focused on kind of America, Europe. We do have some Israel, and then we have some other emerging markets. Like we have 2 deals. One we just closed. One will hopefully close soon in Latin America, where we're seeing like very good macro trends. One's driven really by the nearshoring, and then you're seeing kind of as some of these nearshoring trends occur, somewhat due to global conflict. Some is through trade tension. That creates new needs in countries. And so then you have to look at kind of the governance of the countries. First, you have to look at macro trends. Then you have to look at kind of the intent of leadership. And then you have to look at the capability of leadership to then do the things necessary in order to hopefully allow those trends to flourish to the potential they have the ability to occur. So there's a couple markets in Latin America we're very bullish on. We're actually very close in some deals in the Balkans. Eastern Europe, we think, is an area that's very it's overlooked by people. The supply-demand dynamics in different sectors are really strong. A lot of good GDP growth and some fairly good governance in certain markets. And then, with areas like Israel, I think that, the challenging part is to say, look, it's always rebounded well after. You could see a lot of people wanting to kind of move there after, but they have had a massive GDP growth. Wars are expensive, and you kind of don't get to make up for that lost productivity. So just because things have happened in the past, it doesn't mean they'll happen in the future. So in markets where there's conflict, obviously there's bargains, but bargains are usually bargains for a reason. So you have to always ask, like, are you gambling or are you investing? And I think the job here is to try to be mitigating risk and be investing.
Greg, if we were to stick it in the Middle East and just talk about the opportunities or concerns going forward, obviously this is a region that has known conflict in the past, nothing new here. There's something quite different about this war and what we can expect to see. It's a tinderbox in terms of where this turns next. If Lebanon and Hezbollah becomes involved, we had a conversation earlier about Saudi's potential role here in a post-Gaza rebuilding. What is your take on how this impacts investors and your thoughts about some opportunities?
I think what's going on in the Middle East and even globally is putting a chill on investing internationally. I think if you go back, pre-2008 and where all the capital was flowing, you had this big trend around BRICS, Brazil, Russia, India, China. And you look at net capital now, there's very little capital going into China, very little capital coming from China, no capital going into Russia. Some going into India, but hard to get back out, and Brazil's a question mark. And so I think a lot of the big pools of capital in the West have retrenched because there are massive opportunities in Europe and in the U.S. I think as you think about the region in the Middle East, there's massive opportunity. We heard His Excellency speak about it this morning, and I think what's been fascinating has been Saudi's role in trying to pull everything together and try to be a stabilizing force. And for a long time, I think capital was flowing out of the Middle East into the West, and actually now focusing that capital into the region and building in the region is a super opportunity, both for the capital in the region as well as partners outside. I think with the pivot that the PIF and others have done of trying to partner with capital sources and bringing that capital into the region alongside those funds is super exciting and interesting for us.
Actually, sorry, Bianna, if I can add to what Greg said, because we've been operating in the Middle East for more than 4 decades. Not only can I completely echo what you were referring to, Greg, but we have seen this, right? In fact, Jerry, earlier on, thank you for the shout out. He referred to the gym business that a private equity player invested in 2013, which was then listed and multiplied 4 times post-listing. That was us. 15 years ago, we started investing. But the big shift, whether it's in the GCC or in markets like India, is not the marginal dollar that is coming from the Western investors. It's actually the marginal dollar domestically that is getting redeployed. Many of these markets, from private wealth to institutions, were exporting capital, all of it, or most of it. And now they are keeping a pretty sizable chunk of that capital for internal deployment into advancing their economies, but equally advancing their private markets and the broader capital market ecosystem.
Now?
And just to continue on that thought, I think the difference that we're seeing in the GCC over the last perhaps 5 years, and obviously the bulk of it driven by Saudi, is the fact that previously investors wished to export capital because they didn't see the opportunity. And whenever the opportunity presented itself, it was of a size that was not A, institutional, or B, of attraction. Now what we're seeing is a magnitude of investments across, and I can only talk about real estate, but across all segments. I mean, you're talking about tourism, education, healthcare, logistics, data centers. And in every one of those, there is a magnitude of opportunity that's attracting institutional capital. So the ultra-high net worth families, the high net worth investors, the institutions are deploying in a manner that we haven't seen before.
And if I could say, that actually creates a lot of opportunity. One of the investments we made was actually in UAE. We invested in the leading online classifieds business there, and we saw that basically is correlated to the velocity and then the volume of the real estate market long term. And what we've seen is the business is growing, for 40% a year, top line revenue. Just people are moving to these markets, and as all this investment is coming into these markets, both you have the cheaper capital domestically, and then you have a lot of foreign capital starting to explore how do you come in, and it's a new exploration opportunity, right? For 20 years, you basically had a region where a lot of the money was spent on bombs and bullets, and now it's being spent on bridges and buildings and digital infrastructure. You have a young population there. And then if you look at the Middle East, especially the Gulf, you have kind of this centrally located hub that's pretty close to about 4 billion people, right? So they have access to US market, European market, access to Asia and a lot of the growth there. And then they're really thinking, how can you become kind of a dominant place? And so what I always found interesting was that in the West, we don't really appreciate how good our private sector is. It really is the envy of the world. We have this totally free market system. And then if you go all the way to the East, you have kind of what I call like a mercantilistic, state-driven system. And then throughout the world, there's 200 countries, they all have different kind of models. And what you're seeing very effectively deployed in the Gulf, in a way that probably will be studied for a long time, is the way you use kind of the toolkit of a government, private sector innovation, and then targeted industrial planning and capital in order to achieve objectives. And not everything's going to work, but a lot of things are working, and a lot more things will be maneuvered along the way, which I think will create big opportunities. And then what's happening now is as they do that, the neighbors are starting to compete with each other economically, which is creating even more forwardness. They're copying the things that work. And then I'm seeing other countries around the world starting to say, how can we borrow some of the ideas and try to create some of these policies domestically in our countries?
Scott, how much does the Fed's decision to ultimately cut rates, or whenever that does happen, I mean, that had been sort of priced in to happen sooner, now not so much. How does that impact your investment strategy?
Sure. I think January 1st, everyone in this room thought, 5, 6 cuts. The famed Jan Hatzius, who was spoken of earlier, was probably thinking 5, 6 cuts. Now you're pricing 2 or 3. For us, you're in a yield environment where the shorter duration product, whether it's structured credit or investment grade, is the most attractive part of the curve, because you're probably going to benefit from those cuts at some point this year. I don't know when, but whether it's 3 or 5 cuts, I'm going to benefit from those. If you're thinking further out the curve, the election is going to drive, I think, a lot of the back end of the curve shape. The U.S. is running a huge deficit, and if it ends up with Trump in there, who doesn't really care about how much debt he runs up, you're probably going to have a big sell-off eventually in the long end. It'll be positive for risk assets initially, but you really risk losing control of the long end. And that's not something the Fed has that much control over.
Well, the longer the Fed waits, don't they also risk looking, with the appearance at least, that they're sort of tapping into the election if we're now past June, if we're into early fall?
Very hard to cut if the data is strong, though. You need to see weak data. If the data starts to weaken, they'll cut. The data has been stronger than they expected. If I think about the companies we're investing in, you have this constant microcycle going on since COVID. Cruises were doing poorly, now they're doing well. Housing was doing well, now it's doing poorly. And maybe now it's about to do better again. Until you get a coordinated economic downturn, and maybe we're starting to see a little bit of that low-end consumer weakness that's persisted at the bottom of the economy in the U.S. is now creeping in sort of the bottom of the middle end of the economy. If that starts to creep up more, you'll start to see the data roll a little bit. And then AI, which is going to be huge for corporate earnings, will start to be a job destroyer in the next few years. And that, I think I was talking about it in some earlier panels, that will create a problem as well. But those aren't today problems. They might be next month, 3 months, 4 months, 5 months from now. But right now, the Fed's sitting there saying, I don't have to cut.
Greg, you agree?
I agree. And I think everyone's so focused on the rate cut in the near term. I think the more important thing from the private credit market are the trends that Scott talked about at the beginning. And I think with the increase in base rates and the increase in spreads, you can get low double-digit returns at top of the capital structure in really good companies. So private credit it's the golden age of private credit from that perspective. But I think more importantly are the capital flows that Scott touched on in the debankification, if that's a word, from what's going on. I mean, if you go back pre-financial crisis, all the banks had 30 times leverage, right? And now they're managing to super tight capital ratios that they need to hit every single quarter. All of that stuff is flowing off of the bank balance sheets, and it all is flowing into the private markets. And so you've got a massive shift of capital. And then the other piece, which I think people don't talk about, is just the duration mismatch. Especially in the wake of what's happened at Silicon Valley Bank and everywhere else with technology, what deposits were once thought to be super sticky, they proved to not be that sticky. So you've got short-term deposits inside these banks funding long-term loans, and that's just a mismatch that actually doesn't suit the banks well for the private credit market. But all these investing infrastructures and these funds are super well set up for it. They've got long-duration funds where they can commit long-duration capital to private companies, and that trend's going to continue, regardless of where rates are.
No, yeah.
I was just going to add, the one thing about private markets that probably we know, but we don't give enough attention to is it's a 5-year cycle, right? It is longer than the US election cycle. So when you raise a fund today, you're actually deploying it over the next 5 years, which spans an election cycle, and it typically spans an interest rate cycle as well. So this is really about, trying to take a three-dimensional view, understand the macroeconomic direction of travel, but understand more importantly the interplay with geopolitics, i.e. which parts of the world are likely to witness greater levels of growth, and the mega trends that are likely to shape the global economy over the next 10, 15, 30 years, right? That three-dimensional convergence is really what is going to drive alpha in private markets. And one of the things that we need to always remember is the investors are allocating capital to private markets to capture alpha, not to capture beta. Beta is there for public markets. You can invest in ETFs and indices all day long and capture that beta. The whole idea behind private markets is that surplus return, not just over the public market equivalents, but also in terms of good asset selection, right? Down to the micro level. And I think that means basically you can actually afford, within the private market space, to take that long-term view across those three dimensions and almost ride out the short-term noise created by meeting-to-meeting Fed actions, cycle-to-cycle election results, and so on.
AI and GLP-1s are going to matter a lot more for investment winners and losers the next 5 years than who the president is.
Correct.
I want to get back to who the president is in a minute. But Nael, I do want to ask you about regional banks. Obviously, we haven't touched on them much. They haven't been in the headlines. That doesn't necessarily mean that they're in great health. Are they out of the woods in your view?
Sorry, I didn't get
Regional banks, stability.
regional banks. Well, look, from what we are seeing in what we do, regional banks have contracted quite a bit. We're not seeing any kind of appetite for lending, and hence it has opened the door for this private credit, which is coming in and trying to effectively plug the hole that has been generated. I think the Fed, from what they've done, they've managed to stem the negative tide of other regional banks facing issues. But I think if you look at it from just a barbell perspective, what these banks are exposed to, how much of it is problematic assets, because that's what drove the issue. The actual number of loans that are exposed to problems is not as the magnitude that is perceived in public, and that's why we haven't seen other names come out. The other side is, and we've also seen this in many of our deals, is that the banks are actively trying to work with the borrowers. They're actively trying to amend and extend. They're trying to, wherever they can, avoid pressing the button on calling out a default or a foreclosure. So my humble expectation is that we're not going to see a wave of failures. But it all depends on how long the Fed continues to hold the rates at where they are.
If the Fed's going to keep creating the moral hazard on deposits that they did by bailing out the above 250K deposits, you're not going to have deposit flight. We're looking at a situation right now. The German government's going to be faced with the same decision on one of their Landesbanks banks likely in the next 6 weeks, and they'll probably do the same thing. So that's what stemmed the tide, but the problem assets are still there.
Yeah. Jared, I know that you had said in a previous interview that you are happy here in Miami. If we are to believe Mike Pompeo, he says that Donald Trump will win the election. You've said you're happy here and you most likely would not go serve in a second term. You stand by those words, and what would bring you to work in the White House again?
I'll keep trying to say this in as many ways as the question's asked, but no, I've been very, very consistent. You know, we left government. It was 4 amazing years. Worked very, very hard. We left it all in the field. Again, serving in government is it's an experience I didn't really think I would have in my life. So obviously, it was in the business world. Had an opportunity to do it. We went in. We learned a lot along the way. Got a lot done. Again, didn't leave with any regrets. Felt like I was able to spend every minute I had there to try to make a difference. Very proud of all the different things I was able to do. We were able to get just the administration in general, but the things I was able to work on, the biggest prison and criminal justice reform history of our country, the Abraham Accords, the peace deals in the Middle East. We worked on getting the fastest vaccine in history, and we did the biggest trade deal in the history of the world at $1.3 trillion between US, Mexico, Canada. Each of those things, and then there's numerous other things we were doing every day. So it was very, very intense. We have 3 young children. We moved down here. Obviously, when we left Washington, the intent was to start our lives, the next chapter of our lives. Again, we were not planning to take that break, and that's what really we've been doing, and we're enjoying it, and it's been great.
You were extremely instrumental in advising on policy during the campaign and throughout his first term. We talk about the instability and uncertainty in the world right now, specifically with regards to Ukraine and Israel and the war there in Gaza. There is a $90 billion supplemental that's being on hold right now. Donald Trump is not the official nominee, but he is the one who is at fault for holding this up. If you were to speak to most people, including the Speaker of the House, that he is swaying them not to enact this bill and not to provide Ukraine with funding. I'm wondering if you speak to your father-in-law about this and what your advice to him would be.
So I have not spoken to him about it, but I will say, like, this is pretty preposterous that, you know, a guy who's, you know, at his house in Palm Beach is being blamed for, you know, the fact that, again, we've been told a lot of different things about the war in Europe that have not turned out to be true. I think there's been a lot of things that have been promised. There's been a lot of things that have not manifested. And so I think what people are trying to do is maybe blame the failure of policies that they instigated and stood behind on him, which is what I've seen them do time and time again. But I'll just go to the very basic reality, right? You're saying we have a chaotic world. If you go back to you know, January 2017, when President Trump came into office, the world was on fire. It was an absolute mess. ISIS had a caliphate the size of Ohio. Syria had a civil war where 500,000 people civilians were killed. There were no marches on college campuses, by the way. Yemen was destabilized. Libya was destabilized. All of America's allies in the Middle East felt betrayed based on the deal that you did with Iran, where they were flush with cash and then on a pathway to a nuclear weapon. They were using that cash to fund Hamas, Hezbollah, the Houthis. China was rising. People were saying they were doing Made in China 2025. They were going to overtake America. And it was pretty bleak. Trump comes in and turns a lot of that around, right? He calls out, you know, China's unfair trade practices. We redid a lot of our trade negotiations. You know, go from a place where the Middle East's on fire. We end with 6 peace deals in the last 6 months. Very close to a deal with Saudi. The last deal we got done was the deal between Qatar, Saudi Arabia, UAE, Bahrain, Egypt. Which really opened up the opportunity for Saudi to then join the Abraham Accords and complete that peacefulness.
Do you envision that happening now, given October 7th?
Yeah, I do believe it will happen. And one other thing on there is, and Russia, we had no problems with Russia. You go back to Bush, Russia went to Georgia. You go back to Obama, Russia to Crimea. You go into Trump. When we had COVID, Russia was the second country after the UAE that sent a plane load of supplies to America. So what I would say is that under President Trump's leadership, we had a peaceful world. People feared America. They respected America. We kept them on their toes. And, you know, the policy, maybe these people who are from Washington, they say the right things for the media, or they say what you're supposed to say, but the results are terrible. And so what I would say is that if President Trump comes back, I think now he won't have to do as much learning. I think he's got a lot of great people around him, and I'm very confident he'll be able to resolve a lot of these issues very quickly. And by the way, there's nothing holding up the Biden administration from getting on a plane, and Putin just did an interview, said he wants to have a deal. I'm told from people who are familiar there was opportunities for a deal before. I don't know why people are waiting for Trump. Get on a plane. People are dying. Let's go figure out how to solve this thing.
Well, a deal with Putin shouldn't happen when Ukraine doesn't have the desperately needed money and funding that it deserves. And even if you were to say that a lot of this is attributed to Biden, Donald Trump would walk into these problems if he's reelected. Should the money go to Ukraine?
Yeah,
Do you think it should?
Look, I'm not a person in power to assess. I don't know how the money's been spent. I'm told there's humanitarian aid, there's military aid. I'm told a lot of, there's not been accounting on where the money's gone. So I don't have a perspective to say whether it should go or it shouldn't go.
Right. Well, we'll leave it there. Thank you so much, panel. Really appreciate the time.